Imagine two people starting at the exact same point. Same age, same income, same savings. Both have $50,000 and one big decision to make. One chooses real estate. The other chooses the stock market. Both believe they made the smarter move. But here's the truth. Neither decision is right or wrong until you understand the full picture. The first person uses that $50,000 as a down payment on a rental property. Suddenly they own something real. A house, a tenant, monthly rent coming in. It feels powerful. It feels like progress. Every month, rent arrives, and it looks like easy income. From the outside, it looks like they are winning. The second person does something much quieter. They invest that same $50,000 into index funds and set up a small monthly investment. No tenants, no property, nothing to show off, just numbers on a screen slowly moving up and down. It feels boring. It feels slow. And honestly, it doesn't look impressive at all. In the beginning, the real estate path feels more rewarding. There's something tangible about owning property. You can see it, touch it, talk about it. While the stock market investor is just watching numbers change, the property owner feels like they are building something real. But over time, reality starts to show up. Owning property is not just about collecting rent. There are taxes, repairs, maintenance, and unexpected problems. A broken roof, a plumbing issue, a vacant month without a tenant. Each of these eats into the income that looked so good at the start. And then there's time. Calls at odd hours, managing tenants, handling issues. It slowly becomes a responsibility, not just an investment. Meanwhile, the investor in the market is still doing the same thing. Nothing. No calls, no emergencies, no extra work. Just consistent investing. And this is where something powerful begins to happen. At first, the growth is slow. It doesn't feel like much. But year after year, the numbers start to grow faster. Not because of effort, but because of compounding. The money starts earning money. And then that money starts earning more money. After several years, both paths start to look surprisingly similar in terms of total wealth. The property has grown in value, and the investor's portfolio has grown as well. But the journey to get there is completely different. One required constant attention, risk, and responsibility. The other required patience and consistency. And then comes the long-term effect. Over 10, 15, 20 years, the gap starts to widen, not because one is dramatically better, but because of how the system works. In the market, increasing your monthly investment creates a multiplied effect over time. In real estate, increasing your investment often means taking on more debt, more properties, and more responsibility. But here's where it gets interesting. Neither path is perfect. Real estate has advantages. Leverage allows you to control a large asset with less money. Tax benefits can reduce your overall cost. And in the right situation, it can create strong cash flow. The stock market has its own challenges. Prices go up and down, sometimes sharply. Watching your investments drop can be stressful, and there is no steady monthly income like rent. So the real question is not which one is better. The real question is, did you understand what you were choosing? Did you consider the time, the effort, the risk, and the long-term outcome? Or did you just follow what looked smart on the surface? Because the biggest mistake people make is not choosing real estate or stocks. The biggest mistake is choosing without understanding the full cost of that decision. Both paths can build wealth. Both can fail if handled incorrectly. What matters is clarity, knowing what you're getting into, knowing what you're giving up. Because in the end, it's not about what feels impressive today. It's about what actually works for you over the next 20 years.